here we are at problem 3-34A, okay, and it says Mitchell Fishing Charters has collected the following data for the December 31st adjusting entries. Okay, so with adjusting entries, because we're accrual-based accounting, there's a few things going on. We cannot recognize revenue unless it's earned, right? And we don't recognize expenses unless they've been incurred, okay? So just based on that, at the end of an accounting period, we're probably going to have to make some adjustments to the accounts, okay? So let's see. The first one, it says, what we're going to do is journalize these adjusting entries. Maybe I'll pull this up. So A, and for those of you that are learning My Accounting Lab and kind of getting used to it, it actually repeats itself here right above the entry fields. Okay, so they give you this data, but it's repeated over here. But I'm going to read off of here. The company received its electric bill on December 20th for $200, but will not pay until January 5th. Oh, okay, so we're going to use the accounts payable. We got a bill in the mail, and we're going to record it as utilities expense. Okay. Why is it utilities expense? Well, the bill is for December. Okay. It's just that we're not paying it until January 5th. That's $200. How many had trouble with that?
I think it says to use the utilities payable account.
Oh, it says.
On the.
Oh yeah, you're right. Okay. I read it so fast. Utilities payable. Okay. So when you have a liability that you want to look at separately and not have to dig down into the detail, you could set up a separate liability. Okay. And in this case, it's utilities payable. But it's still a liability. And this is an accrual. So when you hear the word accrual or accrue, that means you're capturing more. So we're actually capturing more expense onto our income statement. Okay? We're getting it onto the income statement. If we didn't make this entry, then what would income be? Would it be overstated or understated? If we failed to make this accrual of utilities expense,
Would be overstated.
overstated, because this entry here is actually making expenses higher. And if you think back to your income statement, as expenses go higher, holding everything else constant, income is going to go lower, because income is equal to revenue minus expenses. Can you see that in your head or visualize that? No? Okay. So why don't we put something up over here? Sometimes it helps to kind of sketch it out. So if you know that net income is revenue, minus expenses, we'll put a big minus sign or a minus sign there. And this is basically your income statement. It equals net income. Okay. So I'll drop some numbers in there. Say you had, we'll go before adjustment, before the adjusting entry. Say you had 100,000 in revenue, and you had 90,000 in expenses. Well, revenue minus expenses gives you net income of 10,000. Okay. Now, say we got adjustment, so after adjustment, right? Nothing happened to revenue. Let's see. Maybe I can slide this over and we can look at it. But notice expenses went up by $200 because utilities expenses increased. So you now have 90,200 in expenses. You see the difference? And if I take, right? So I can, right? You can always do that in your head. Expenses increased, everything else held constant, net income decreased.
Okay, and when do we add the adjustments, and how do we define the adjustments again? It's after this P3 and
Yeah, we made one adjustment, right?
Okay.
So I just did a real quick sketch here for you,
Okay.
but that's the effect of the adjustment. This is not a adjusting trial balance where you have
Okay.
unadjusted.
That one is.
Yeah, we can show you that in a bit, but the idea is you want to get these adjusting entries solidified and how to do them, okay? Now let's see. Oh, and then you can hit check answer. Okay. So B, it says Mitchell purchased a 3-month boat insurance policy on November 1st. So sometimes you have to either have a number line or draw it out if you feel like you have to, but I'll try to do something. So here's a time frame. On November 1st, this is when they bought the policy. Okay? So this is, what year is it? They don't give us, we'll go XX. Okay. So that's November 1st when they bought the policy. Now we're over here at year end, so we're at 12/31. Okay? And we probably have to make an adjusting entry. Okay? So if you think about it, when they bought the policy, they paid $2,700. Your numbers might be different if you're working along with me. So think of the entry. When you made the entry, when you bought it, policy on November 1st, it's a 3-month policy, but as of November 1st, you haven't received any coverage. So if you think about back at November 1st, you would have had an asset called prepaid insurance. Okay? And you would have spent cash. Okay, so that would have been $2,700.
When does the policy go into effect?
Okay, technically it will go into effect on November 1st.
On.
Right. Okay. So when you buy it, it's prepaid insurance. As soon as it starts benefiting you,
Effective.
then it starts to become insurance expense. The problem is we're not going to record insurance expense every single day. It's not efficient. Okay. When do we make the adjusting entries? We usually make them when we get to the point where we have to prepare financial statements. Okay, and that's the key, right? Financial statements, probably for you guys throughout this class, will be calendar based. Okay, so at year end, we're going to need to have a set of financial statements that show us what happened for that year, as well as what we have and what we owe on the date of that financial statement, which is December 31st, whatever year they have involved here. I don't know if, did they give us a year, Gavin?
I don't see it.
I don't see a year. So I put XX for the year. But that's the end of the fiscal year, end of the calendar year as well in this case. So when we get to the end of the year, we have to think, okay, what was this 2,700 in insurance? And that represents an insurance policy. Now, between November and 1st and December 31st, what did we get from this insurance policy? We got coverage. Right. 2 months of coverage, exactly. So what we have to do is when we make this adjusting entry, we have to adjust that amount for 2 months worth of coverage. Yeah, you could do that. You could do that. Or you could think, well, this is a 3-month policy. It's not an annual policy, right?
Oh, that's a 2-month policy.
Yeah. So you could take
Okay.
$2,700 divided by 3 months. That'll give you 900, which is the monthly. Right.
Because you need to adjust each.
Yeah. And then you come down 900 times 2 months, right?
So we're only, oh, this is for the financial, okay.
So I gotta make an adjusting entry. My adjusting entry has to reduce my prepaid insurance and increase my insurance expense. Okay. Remember, we record expenses when they're incurred, and expenses are incurred when we receive the benefit of it, right? The benefit of that cost. So in this case, we didn't receive the prepaid insurance. We didn't receive any insurance benefit until the policy elapsed, if you want to use that word. So I'm going to go debit insurance expense, credit prepaid insurance, 1,800. 2/3 of the policy, because we got one more month left. That policy is going to cover us in January. So this is an example of an adjustment to a deferred expense. Okay. Why is it a deferred expense? Well, this asset here that I told you about, this prepaid insurance, I'll point with my box. Okay. This prepaid insurance, that's an asset, but it could also be referred to as a deferred expense.
Yeah.
We've put money into something and we're deferring expensing it until we get the benefit from it. Okay? So when we make an adjustment to a deferred expense, it's always going to be a debit to the expense and a credit to the asset. Versus this accrued expense, which we did in the first entry. In the accrued expense, we actually captured more expense. We accrued more. Okay? And I think your book might label, your book's going to categorize the adjusting entries with these names that I'm giving you. Okay? Any questions so far? The other thing about adjusting entries is there's always going to be a balance sheet account and a income statement account involved. Just review real quick, right? Income statement is the expense, balance sheet is the payable, right? Over here, insurance expense is the expense. Insurance expense is the income statement account. What did I do? Insurance expense. And prepaid insurance is an asset on the balance sheet. So you always have that double financial statement effect, if you want to call it that. Okay. Now, as of December 31st, Mitchell had earned $4,500 of charter revenue that has not been recorded or received. Okay, this is going to be an example of accruing revenue. If I don't make this entry, if I don't put that $4,500 in revenue on my income statement, what's going to happen to my net income? Is my net income is going to be, okay, let's go back. It's going to be understated, right? Because I actually need 5,000 more. Take this out, okay? So if I don't make the adjustment, I got net income of 10,000. When, if I make the adjustment, I'll have 100,450 more in revenue. Okay, I'm kind of already giving you a hint as to where that revenue is going to go on that income statement.
Overstated revenue, understated expense.
Okay, so if we do not make the entry, we've understated revenue. Okay, if we just stay here and not make that entry, forget about the other two entries we made. Okay, notice my revenue will be understated. So to properly state my revenue, I have to make an adjusting entry to accrue revenue. But it says we haven't collected any revenue yet. Right. So what account do I use when I haven't collected the revenue, but I earned it? Okay, accounts receivable. And then I will go ahead and book the revenue. 4,500. That's an example of an accrued revenue. We're accruing more revenue. So to accrue service revenue. Fantastic. Really similar to the way you would record something when you bill a customer. Almost exactly the same. If you really wanted to get technical about it, you might use an account called accrued revenue instead of the receivable and treat that as an asset. And then when you actually do send out the bill, you could swap out the receivable for the accrued revenue.
Okay.
Right? If you wanted to get real detailed about it. But in this case, it's fine to put it right into receivables. Generally, in practice, receivables would be supported by invoices to customers. You see what I'm saying? The invoice would generate the receivable. And the adjusting entry would be a journal entry, an entry that an accountant would make right into the general journal. Okay. Let's see now. Letter D. Mitchell's fishing boat was purchased on January 1st at a cost of $79,000. Mitchell expects to use the boat for 5 years and that it will have a residual value of $4,000. Okay, so we're going to jump now. We're in a chapter, a future chapter, where you compute depreciation expense. Can anyone tell me what depreciation is?
Depreciation is the amount that your equipment or asset devalues according to the time. Like, say you buy a car for $10,000, the depreciation cost would be what you paid on that car divided by the months that you expect to use that car.
Okay, so you use the word devalue, which is okay in lay terms.
Yeah.
But what you're really doing with the math is you're actually allocating the costs.
Yeah.
So our objective in accounting with depreciation is we want to match expenses to the revenue that they help us earn. So what we have to do is we have to take the cost of this fishing boat. The fishing boat's not only going to help us in the first year, so we can't expense the entire cost of the fishing boat in the first year. The fishing boat's going to bring us benefit throughout the year.
Yeah.
So it's really allocating the cost. I think like if it was like a real estate profession or that type of thing, then when we talk about depreciation, that part about devaluing has more to the meaning. There is a little bit of that in this, but really our objective as accountants is to allocate this cost. Okay, and it probably does reflect a little bit of the devaluing of it, because eventually it's going to be worthless, or it's not going to have any benefit to us. Okay, so some of the terms that they used were cost. So this is the historical amount that we paid for it. That doesn't change. That's the cost. That's not the market value. And then they had a term called residual value. Sometimes it's called salvage value. And you know that's actually what you think you can get for that piece of equipment when you're done using it. Like, say you buy a truck and after 10 years, you figure you're going to get a new truck, and this truck that you have is no longer going to be useful to you, right? But it still has value to someone else. Maybe you can sell the truck for $5,000. Okay, so that would be the residual value or salvage value. Okay. A lot of times they list it as 0, but in our case, we have a salvage value, and that's estimated, by the way. Right? They should say that that's estimated. Cost is an actual figure. Residual value is estimated, and then we also have estimated useful life of that asset. Okay, so estimated useful life doesn't mean that the asset no longer works. It just means the time frame that it's going to be useful to our company. Right? You think about like certain things get obsolete as well, right? Technology improves. We're going to get rid of this, maybe give it to a non-for-profit, and we're going to get the latest technology. So someone else could probably use it, but as far as the company's use, it may no longer be useful. So that's an estimate. So you got two estimates involved here. Okay. So the straight line depreciation expense will equal, here's the formula, cost minus residual value and divided by estimated useful life. Okay? So if you look at that, you have this thing in parentheses, that's your depreciable base or your depreciable cost. So in our case, if I refer back to the problem, it says that they bought the boat for $79,000, and they expect to use the boat for 5 years. Okay, with a residual value of 4,000. And it's kind of nice in this problem because they bought it on January 1st.
Yeah.
So you're gonna get a full year. If had they bought it at mid-year, then you would only take half a year's depreciation. Okay, it gets a little more tricky when they bought it maybe like on September 15th. Then you gotta figure what fraction of the year do I need to apply to my annual depreciation to get the amount that I record. Okay, I'm gonna show you how we do it. So
Is it, real quick question.
Yes.
You talked about what fraction of the year. Is there a uniform number for accounting?
uniform number.
Yeah, like, you know how sometimes, I don't know, do we always have 365 days a year?
Oh yeah, you know, a lot of times in textbooks when you're dealing with a year, they'll use 360.
Yeah, that's what it,
Just
I
for
saw.
ease of calculation,
Okay.
because what is it? 12 times 30 is 360.
Yeah.
So they're just making every month 30 days,
okay.
right? When you get out in practice, then you'll get a little more picky about that, and you'll,
Okay.
right? Some years have 366, and some have 365, right? Some months have more days than the others, so
So there's no standard.
depending on how exact you're gonna be. So we have this thing called materiality.
Okay.
Is it gonna be material to someone making a decision using this information,
Got it.
right? That means, does it make a difference when I make my decision, right? How significant of a difference does it make? If it's really important for me to know that, then you better be doing it as an accountant and letting them know. Okay, if averaging it to 30 days a month doesn't make that much of a difference, then it's what we call immaterial. It wouldn't make a difference to somebody reasonable making a decision based on that.
Okay, it's immaterial.
Okay. All right, it's immaterial. Okay. I can tell you a story about that immaterial. So I was on a job in Palo Alto, California, carving out, I won't, since this is recording, I won't say the company, but it was a big company in the billions. And they were carving out a section, a division, and it was gonna become its own company. So our job was to go in and put value on all of the things that were being carved out, right? And you know, we're dealing with billions. So we talk about immaterial. Hundreds of thousands could swing one way or the other, and that would be immaterial in our analysis, right?
Wow, must be nice.
When you're working with billions, if you just drew the number 1 billion out, right, or 10 billion in that case, 100,000 either way didn't make a difference. Okay, that was immaterial. Okay, so it's all relative to what you're dealing with. Now, if you were with a company that's making 50,000 a year in revenue, I mean, you'd probably be down in the maybe even the cents, right? It would depend on the owner, right? Where you're at. Okay. So I'm going to take my 79,000. I'll show you the math. Minus 4,000 salvage value, and I think they said a 5-year life.
Divide by 6.
Okay. Now, we could do months, but we don't have to because we got full years.
Oh, okay.
We'll just do 5 years.
Oh, 5 years.
Because we bought it on January, right? January 1st. So what, is that right? 71,000?
75.
Oh, 75,000. That makes a nice number, right?
Yeah.
So 75 divided by 5. You already got it? I'll do this. You're probably right. 15,000 per year. That's going to be our depreciation expense. Does everyone understand the terminology and what I did to get that? Okay. I'm going to take a little bit of an aside on this. Okay. This is the instance where we bought on 1/1 and recording on 12/31. Okay, so we got a full year, right?
Yeah.
Now, just for discussion purposes, this is not our problem, but say you bought it on, make a funny one here, May 1.
First year.
Yeah, say we bought it in the first year on May 1st.
Okay.
Okay. How much depreciation are we gonna take?
You take off 4, 12 times 4.
Well, first of all, you gotta think, okay, as of December 31st, if we bought it on May 1st, how long did we own it? You can use your finger. I use my fingers all the time, right? So I go.
Bought it on 8 months, right?
You start with all of May, right? May, June, July, August, September, October, November, December. That's eight months that we've owned it as of December 31st. Right, so like Tia said, right, you could divide by 12 and multiply by 8, but I mean with computers we have, right, you could just go 8/12 of a year times the 15,000, okay? And that would get you the fraction of the annual depreciation that you need to book, okay? We're just coming up with the amount. So times, that's 2/3, right? Yeah. So 0.66667 or something like that. 10,000. Yeah? See what I'm doing? Okay. So that's something that you want to keep in the back of your head for a future chapter. Now we don't need it. We're going to use our 15,000. Okay, so we solved, we got that. So the entry to make this depreciation expense, or to record depreciation expense, is going to be a debit to depreciation expense. So that's going to cause net income to go down because now we have more expense on the income statement. And then what we're going to use is we're going to use an account called accumulated depreciation. And again, this is an example of an adjustment to a deferred expense. The boat's cost is actually a deferred expense because we're deferring recognizing it as an expense until we actually start using the boat. Okay? Now, this accumulated depreciation, it takes the place of reducing the boat directly, right? Like with prepaid insurance, we're able to reduce the asset directly. But because we have to show our long-term assets at cost on our balance sheet, we need another account to reduce that cost. So we're always going to list that boat at 79,000, right? No matter how long we go into its use. But we're going to have this accumulated depreciation sitting right under that boat on our balance sheet, reducing its book value.
So it would be on the asset side.
It would be on the asset side, but it would work opposite of an asset.
Okay.
As accumulated depreciation increases, we actually credit it.
Yeah.
So because it works opposite of an asset, we call it a contra asset. Just like the traffic, right? You're in this lane,
Contraflow.
and then at 4 o'clock, when do they start? They move the cones over, right? And your lane is supposed to be going that way, but now that the cones are moved over, your lane is going the other way. Contraflow,
To 9,
right? 6 to 9?
6:30 to 9.
Yeah. Oh, you live that side? Oh, Kahuku. They don't have that down there because they put
Yeah, because I gotta come to Kayakili.
Oh. Well, they put in a new lane, yeah?
Yeah, but they contraflow because it's 2 going north and 1 going.
Oh, yeah, just between and a dip, right?
Yeah.
Yeah, that's it, yeah. Okay. So that's what it is. So contra asset is working contra to what an asset would do. But notice it's paired with an asset.
Yeah.
Okay, so that accumulated depreciation is really going to be paired with the boat's cost. Okay, now remember this. The difference between the cost and the accumulated depreciation is the book value of the boat. Okay, that's what we call book value. Okay, so because our rules require us to always show those long-lived assets, property, plant, and equipment, that type of thing, we always have to show it at its cost. We need another account to have on the balance sheet to reduce the cost to book value, to show what the actual book value is, okay? So that comes into play. It's really almost exactly the same adjustment as we did for prepaid insurance. It's just that we're using a different account to show the reduction, okay? And we're gonna say to record depreciation on boat. Okay? I think this is the last adjusting entry. Okay. Let's see. On October 1st, so go back to your timeline. We can use this timeline. Okay, and we can wipe some of this out. Remember, we're always going to be making these adjusting entries at the same time that we need to date our financial statements, okay? So the adjusting entries are really made to produce the financial statements, okay? To bring our books to an accrual-based format, which complies with generally accepted accounting principles, right? GAAP, GAAP, generally accepted accounting principles require that we use accrual accounting, okay? So let's see. I'm going to come back over here. I'm going to read carefully. That's the thing about this stuff. It's not like leisure reading, right? You got to read really carefully. It says on October 1st. So in the back of your head, you're already thinking, okay, October 1st, something happened. We received $7,000 in prepayment for a deep sea fishing charter to take place in December. As of December 31st, Mitchell has completed the charter. So you really got two things going on. You don't have to draw the entry out, but for you to see what's happening, right, I'm going to put in October 1st. And what happened on October 1st is we received cash, or Mitchell, right? So when Mitchell received the cash, was it $7,000?
Yeah.
Yeah. They got cash up front, but they haven't performed any services for the people paying them, or the company paying them, right? These people want a charter. They want to charter the boat, but Mitchell has not taken them out on this charter tour or this charter fishing trip, okay? So what Mitchell has is Mitchell has an obligation to provide that charter.
Payable.
Well, that's a very good guess, but we can be even more specific. It is a liability. We don't owe them money back. We really owe them services. Unearned. Yeah, you can go as far as to say unearned service revenue. All right. Yeah, sometimes you just say unearned revenue. Now the technical term for that type of account, because you can have all kinds of unearned revenue, is that's really called a deferred revenue. Okay? It gets to be simpler when you realize that the word deferred is what it means. It's being delayed. So that unearned service revenue is a deferred revenue account. It is a liability because we owe something, right? We owe this service, and that's supposed to happen in December. So on October 1st, this is what would have happened. Okay? Now sometimes you got these unearned revenues that overlap year end, right? Oh, maybe it was for 2 charter tours, and we only did 1 as of December 31st. So we would only make an adjustment to move the value of 1 charter out of that unearned revenue. In this case, it's real simple. They did all the work by the end of the year. Angela, right?
Yeah. This is DR and C.
That means debit and credit.
Oh, okay.
Yes. So debit is always left, credit is always right.
Okay.
No matter what account you're using. Remember I did those T accounts, right? We also do it in journal entries. Notice that the debit is to the left and the credit is to the right. And I put DR and CR to stress that. But the more important question, which I'm surprised, I'm glad you asked it. That's a very good question. But nobody has asked me yet. I don't think I explained it. How come it's DR? There's no R in debit, right? How come nobody asked that? It comes from the Latin or Italian. Oh, that really looks okay. Latin or Italian for debit and credit. That's what it comes from. Because this individual, Luca Pacioli, from the Renaissance 1400s, is considered the father of modern accounting. And he was a mathematician, so he came up with this thing called the double entry bookkeeping. Notice everything is double, right? Every time we make a transactional entry, we got a double effect, a debit and a credit. Okay, so it is rooted in math, but the math we're going to use is not too complicated. Okay, so you could figure out what the Latin or Italian word for left and right, I think, or debit and credit. You could Google it or Wikipedia. Right? That's why we continue with the abbreviation DR and CR. Good question.
So, say he didn't complete the charter in December, and he went into the next fiscal year.
But did he do some of the charter? Or if he didn't complete any of the charter, it would just sit on there. We wouldn't have to make an adjustment.
Oh, okay.
It would just be an
Yeah.
service revenue.
Yeah.
But if he completed just part of that charter, then the part that he did is the one that we
We would adjust out.
kept.
Yeah.
Right.
So another example of this would be, why don't I make a little example down here, since we've got a good discussion going on. Say we were doing yard services, and we got paid to do, we get paid $100 to do a yard, and we got 10 yards, right? So this, maybe it's a company with several properties, and we go and we weed eat the curbs or something, you know? So we get $100 for every site we go to, right? So on October 10th, we got $1,000 cash, okay? And then we got unearned revenue sorry, 1,000, right? And then if you had a memo in there, you would say paid up front. Let's just see. Customer paid up front for 10 yards. Not 10 yards on a ruler, 10 yards that we gotta go clean, right? Okay. And then say as of December 31st, so this would have been the 10-1 entry. Say as of December 31st, we cleaned 4 yards, right? So this is what we're leading to. For our problem, which is up here, let's keep our problem separate. So I'll make our problem gray. Okay. For our problem, we're not to December 31st. That's back in my accounting lab. I'm going to show you how to do that. But I'll show you with this example, if we had cleaned 4 yards as of December 31st, we would have to debit unearned revenue, because we've now earned the revenue, so we're going to credit revenue. Or you guys have, your book is calling it service revenue, right?
Yeah.
Ah, your fingers get thicker as you get older. You don't do what they.
400.
Jeez.
You don't know that yet, okay? Okay, this is to record revenue earned. Yeah, an adjustment to record revenue earned from the amount that we previously. So carrying it forward into the next year. Yeah. And what's always good is to do a T account. So if we were just, every account you would do a T account for, by the way. But in this case, if we were just focusing on unearned revenue, on the unearned revenue account, right, you would have started out with 1,000 on 10-1, and then you would have adjusted off 400 on 12/31, and your balance would be 6, right, Letitia? And how do I get my balances? I figure out how much total debit I have and how much total credit I have in that account, and I get the difference. And the side that has more on it is where I put the balance. I don't even have to, I keep using I'm just accustomed to doing everything with Excel, and then this would be your 12/31 balance. Adjusted balance, in fact, because it's after an adjusting entry. Okay. You might even label this your adjustment here. December 31st adjusting entry. Okay. So this is not really part of the problem, this stuff in yellow, but it's a good side discussion that we went off on. What we have to do now is we have to make our December 31st adjustment for the stuff in the problem. And if you recall, the problem tells me as of December 31st, Mitchell has completed the whole charter. So we know that we're going to take what we have sitting in unearned revenue, which is 1,000. We don't have any beginning trial balance where there might be more sitting in it. It's just assumed that that's all we have in there. We're going to have to take that out of there. So I'm going to go debit my unearned revenue, 7,000. And I'm going to turn it into revenue because now we have provided the charter, right? Okay, so be careful down here. The selection, the right one is to record service revenue that was collected in advance. When it was collected in advance, it was booked as unearned revenue, a liability. Okay. So again, this is an example of adjusting a deferred revenue account, right? The unearned service revenue, which is a liability, is also a deferral of revenue. Let's see. What does this say? Oh, these are the good questions, right? If Mitchell had not recorded the adjusting entries, indicate which specific category of accounts on the financial statements would be misstated, and if the misstatement was an overstatement or understatement. Okay. So begin by completing the table for adjustment A. Okay. And then we'll do B through E. Okay. So let's look at A. And we already kind of did this in Excel. If I don't make this entry, right, my expenses would be understated. Expenses have an effect on net income. Net income would be overstated. And therefore equity, because net income goes into equity through what? I'll use the word financial statement. How does net income get into equity? There's a financial statement and it gives you a figure at the bottom called retained earnings, right? You guys remember?
And the retained earnings is actually the
Yep.
second.
Yeah, after you figured out your net income, right?
Right.
So if I don't put enough expense on my income statement is going to be too high.
Yeah.
My retained earnings is going to be too high. And that's going to cause my equity, because retained earnings is in the equity section of the balance sheet. My equity is going to be too high. So there's a whole interconnection. Okay. So that's the expense piece of it. Now think about the payable. If I don't make this entry to the payable, that credit to the payable, what is that doing to the payable? That's
Keeping it high.
That's increasing the payable. That's the liability section of my balance sheet. If I don't make that entry, if I didn't make that adjusting entry, my payables would be too low. I wouldn't be telling my investors everything I owe. That would be misleading. I mean, the numbers look small here, but if
Yeah, Theranos.
if you're hiding something, right? Hiding something is the same as lying, okay, in the eyes of the law, right?
Yeah.
Right. Okay. And then it could get even worse, right? Because if you intentionally hide it, that's fraud. Okay. If you accidentally hide it, like, oh, I didn't know, that's negligence, right? Okay. There's negligence where it's an honest mistake. It wasn't shown on the balance sheet as the payable amount that you owe. Honest mistake. And then there's what we call gross negligence. Okay. So fraud, you have to have the intent. You intended to hide what you owe, and it caused damage to somebody. That's fraud.
But then can't people just say that they did it to avoid fraud? Like, how do you prove fraud?
They have people that can determine that it was fraud. Specialists, forensic accountants.
What?
Yeah, they do. If you like this stuff, you can get into that. You can take this a whole career and become a forensic, investigative type person. Maybe even have a sidearm on you, because you get into some fishy stuff. Okay. But between negligence and fraud, there's gross negligence. When you should have been doing your job, you're just sloppy, lazy, and something didn't get recorded. That's gross negligence. Okay. Anyway,
Fraud.
so we got that in our head. We can come back down here and say, okay, if we didn't make this entry, specific category of accounts on the balance sheet. Well, of course, there's going to be equity and there's going to be liability, right? Would the equity be overstated or understated? It would be overstated because net income would be overstated. Right? Net income goes into retained earnings. If you have an income figure that's too high, it's going to make your retained earnings too high. And retained earnings is on the balance sheet in the equity section. Okay. Of course, we've already established that the liability would be understated. If I didn't make that $200 credit to utilities payable, my liabilities would be short by $200. Okay. And this kind of answers it already. It says expense. Okay. Specific category of accounts on the income statement. Expense would be understated. Specifically, utilities expense would be short by $200. So this is how you do these. And you click along. And then you get better at it, right? And what this helps you do is it helps your brain get the interconnection between all of the financial statements and how these elements affect each financial statement. Let's see what B asks me. Okay, B, just look at it. Okay, what's B? B is an expense. And this entry is making expense higher. And prepaid is an asset.
Yeah.
And this entry is making assets lower. Okay, snapshot that in your head. Okay. Now, if my expense is not recorded, my equity will be overstated. Okay, and again, I'll walk right through it. Because if expenses are too low, income is too high, retained earnings is too high, equity is too high. Okay. Now, the other balance sheet account was an asset. It was prepaid insurance. But that entry was crediting the asset. It was reducing the asset. So if I didn't make that entry, my asset would be overstated. I would not have reduced my asset enough. Okay. Now, that was, what was it doing? It was moving prepaid insurance into insurance expense. My expense would have been understated because that entry was creating more expense. We can take a real quick peek again. Notice that's actually increasing insurance expense, the debit to insurance expense. Let's check our answer. It says, good job. We'll come back and we'll look at entry C. Okay, accounts receivable is an asset. And this entry is increasing my asset. Service revenue is revenue. Revenue affects equity, right? As revenue increases, equity increases because revenue is on the income statement. The more revenue you have, the higher your net income is. The higher your net income is, the higher your retained earnings is. Higher your retained earnings is, the higher your equity is. Okay? So we just look at this, right? This entry is increasing my asset and increasing my revenue. So if I don't make that entry, if I don't increase my revenue, then my equity will be understated. I'm not showing enough revenue on my income statement, so I'm not showing enough net income. I'm not showing enough retained earnings. I'm not showing enough equity. And my asset, which is accounts receivable, would be understated. I'm not showing enough of what is owed to me. Okay? And then revenue would be understated. Okay? What was D? Okay, so you're going to treat the accumulated depreciation as a decrease to your asset section. Okay? It's a contra asset account. So if we did not book this accumulated depreciation, then your assets would be too high. Okay? Again, depreciation expense, that's an expense, just like the first two we did. If that expense is not recorded, then equity will be overstated. So we go equity, overstated, assets, overstated, and expense, understated. Because if we don't record depreciation expense, then our expenses are understated. And then finally, E. Okay, unearned revenue is a liability. This adjusting entry is actually reducing the liability. Yeah. And service revenue is revenue. Okay, so if you think about it, if I don't record the revenue, then my equity will be understated. That's because my income is understated and my retained earnings are understated. Okay, so I know my equity will be understated. Okay. My revenue, I'm sorry, my liability, which is the unearned revenue, would be overstated. Because that entry here is reducing the liability. You got to go back and remember your debits and credits. Those are the tools we're going to be using for everything going forward. So if you don't understand how a debit and a credit affects each particular type of account, it's not too late. Go back and practice with it and learn it. There's about 10 or 11 specific things that you gotta know that we gotta carry forward with us. These tools of debiting and crediting. Okay. Let's see. And finally, revenue would be understated. I think we did it. We got it done.